Bloomberg Audio Studios.
Podcasts, radio, news.
Single best idea. And the theme today was very simple. I was stunned by the quietude of the weekend. The Bears just humbled. There's no other way to put it. And I'm sure they'll have their day again. And the Bulls, and I just wonder where the exuberance is. And it's wrapped around the actual emotion of the stock market, and culturally maybe the way we buy bonds now and buy stocks has changed so much. Eric Balchunas today was definitive on ETFs. The most stunning thing Eric said to us, I asked him, and the traditional mutual funds, they're doing okay in bonds, but they saw, and I don't have the number in my head right now, but they have a massive outflow in the equity markets of the traditional mutual funds. And of course, so much of that, I assume, is going to ETFs. So there's a whole new chemistry to what we do. I mean, there's just no other way to mention it. And with the stunning stock market lift that we saw Friday afternoon to Dow 40,000, with Ed Yardeni's note over the weekend where he models out Dow 60,000, a 7% return out to 2030. And just the quality of this bull market is so odd. Our team put together an eclectic set of conversations over the weekend. And here is George Saravelos. He works for David Fokerts-Landau and Peter Hooper and the crew at Deutsche Bank out of London. He writes brilliant short notes with their conviction, and a lot of the conviction, this goes to his colleague Alan Ruskin as well, is the correlation of the foreign exchange signals that we see with equities, bonds, and commodities. Here is George Saravelos of Deutsche Bank on the dollar and stocks.
So our theme is low vol persisting. In an environment of low volatility, carry tends to do quite well. So in FX, you should see more of the same. But I think a crucial point is the dollar is a high yielding currency. And if you think about the start of the year, so many people made the argument that if equities go up, the dollar should weaken, and the dollar strong despite equities at record highs. And that's because it's part of the carry trade. So we're positive on the dollar, and we're positive on carry as well.
I'm going to editorialize here and say what I watch is nominal GDP. I thought Michael McKee was brilliant today after his conversation with Raphael Bostic of Atlanta, the Fed president of Atlanta here. And just, you take Atlanta GDP now, and it's coming down as it does across, as it does across 90 days. But, say you're 3% GDP, 2.8% GDP, I don't know what it is. And you fold on that the inflation component, and you got a nominal GDP above 4%, and dare I say it could be above 5%. And that's the animal spirit driving America. And to the brilliant work of Raphael Bostic at the end of that interview, do you disaggregate America into the haves and the have-nots, or do you aggregate America into one piece? That's a raging debate that'll be one of our key themes through 2024. Tracie McMillion is with Wells Fargo, and is really quite good on asset allocation, about making choices of what to do, and just as importantly, what not to do in stocks and bonds. Let's listen.
We are seeing these rises in the market supported by higher earnings, and a lot of policy has contributed to these higher stock market prices this time. So there's some fundamental justification behind some of the rises that we've seen. However, there are pockets of the market that are probably getting a little overpriced. Communication services has done really well this year. Information technology has done really well. Those are areas where we'd be trimming and putting that cash into short-term fixed income and just waiting for a better opportunity.
For that big correction to come in. Yeah, that's the point. I was to make a joke there. Trimming. Trimming is the new phrase for sell. I just don't know why. We would like to sell this or buy that is how we used to talk, and now we've got this whole jargon of asset allocation. But really, the elephant in the room, as Paul has been brilliant on, Paul Sweeney, is the need for a correction, or what is the new correction. I don't buy the idea that we have prospered our way out of a normal correction. On the SPX, I'm going to frame that as a 10% correction, an 18% bear market, some would say 20% down bear market, and the real understanding that every once in a while things fall apart and you reset down 35%. We don't have to look back too far for 2 or 3 once-in-a-lifetime events like that. But the answer is we haven't seen that. And I find the bull market lassitude now is mostly about that fear that is evaporated. Yeah, we'll have a little spike up to 25 or 30 in the VIX, but we haven't had that real fear set in. That'll be one of our themes here as we move PCE at the end of the month and on to the June 12th Fed meeting. Lots of economic data, lots of discussions on the market. We're on Apple CarPlay, Android, on YouTube. Search Bloomberg Podcasts. Subscribe to Bloomberg Podcasts. This is Single Best Idea.